Welcome to the deep dive. You know how it goes. You give us the sources, and we pull out those really valuable nuggets of information for you. And today, we are diving deep, really deep, into how the wealthy, how they use cash value life insurance, not just for the death benefit, the obvious thing, but as a serious way to save and build wealth. And our guide for this journey, well, it's Jake Thompson's book, Money, Wealth, Life Insurance.
That's it. The stuff you sent over, it goes way beyond the surface. It delves into the history of this whole approach, the real advantages it can offer, and even how it's being used out there in the real world. Plus, some pretty surprising historical facts and how some big names have used it to their advantage.
Absolutely. So our mission in this deep dive, it's pretty clear. We've got to distill, really get to the heart of Thompson's message so you can walk away understanding the power of this financial tool that so many people overlook. All right, let's jump right in. Thompson, he doesn't waste any time, does he? Starts with history.
Not at all. The book, it opens by laying out this idea that cash value life insurance is not some newfangled thing. It's had a long history.
Yeah.
And get this, he traces it all the way back to ancient Rome. What gets me is how much he stresses the fact that it's been around for so long.
Yeah. He makes a really strong case that this approach, this tool, it's weathered the storms, financial storms, I mean, even huge things like the Great Depression. That's a pretty bold statement.
It is, and he uses some really powerful words to paint a picture. Calls it, get this, a personal bank on steroids. And even a financial bunker, when things go south. Those are some strong images.
They are, and it's obvious what he's trying to do with this book, right? He wants to show us how wealthy people, how institutions like banks, big corporations, how they've used and continue to use life insurance to build their wealth.
Exactly, and this is key. We're not talking about just any life insurance here. He's very specific. He focuses on what he calls high cash value life insurance.
So this isn't that, typical policy you might get from, just any insurance agent. He even contrasts it with that, with what he calls the less effective kind most people are sold. He's presenting it as a supercharged savings vehicle.
And what really makes it hit home are those real-world examples he gives to show how well this can work. He mentions some names you'll definitely recognize. Walt Disney, JCPenney, McDonald's, Foster Farms, even big institutions like Stanford University and Pampered Chef.
That's quite a list.
Yeah.
And he goes into detail how they actually used it. Like JCPenney during the Great Depression, they borrowed against their policies to keep the whole company going. That's pretty powerful.
It is. And then there's Walt Disney. The story goes, he used it to get the money he needed to start building Disneyland because banks, they just weren't lending for something like that at the time. So these aren't just, ideas. They show how powerful this can be in tough times for big, ambitious projects. Even for those massive companies facing real threats or taking on those huge endeavors.
Yeah.
They saw cash value life insurance as something solid to build on. It wasn't some kind of risky gamble.
Right. So we've seen how both individuals and businesses have used this to their advantage. But Thompson, he spends a lot of time talking about banks and corporations too. And this is where things get, really interesting.
Definitely. He makes it clear. Banks and corporations are pouring billions of dollars into bank-owned life insurance, or BOI. And corporate-owned life insurance, COALI. That's a serious amount of money.
It is. And he talks about why they do it. It's not just about the death benefit, is it?
Nope, not just about that. He lists several reasons, like making their overall finances more stable, taking advantage of the tax benefits you get with these policies, and using the money to fund pensions for their employees, even to cover healthcare costs.
And he brings up something important about how BLI is viewed by the people who, regulate the financial system.
Yeah, he talks about the FDIC, the Federal Deposit Insurance Corporation, and how they actually let banks classify BOI as Tier 1 capital. Think of Tier 1 capital as the foundation of a bank, the most secure kind of assets they have. The fact that the FDIC lets BOI count towards that, it really tells you something. It shows that they see it as safe and dependable.
That's like a gold star from the regulators. And it's not just a couple companies doing this, right?
No way. He actually quotes a statistic saying that over 68% of the Fortune 1000 companies, they use life insurance to fund those special retirement plans for their top executives. Those SRPs, supplemental executive retirement plans. That's a huge chunk of the biggest companies out there.
And even though we don't have the exact numbers for what each company holds, the fact that So many of these big players are doing it, and in such a big way, it kind of tells you there's something to this, something worth looking into.
Definitely. Makes you wonder, right? If these sophisticated institutions, if they're using it so much, what are regular people missing out on by not considering it?
Exactly. Which leads us to, I think, one of the most important points Thompson makes. He challenges some of the conventional wisdom about retirement planning. The advice we've all heard for years.
That's a big theme in the book. He argues that, we've been led to believe that the best way, the only way almost, to prepare for retirement is to invest heavily in the stock market, with all its ups and downs.
He even looks at the historical shift, how things changed. Back in the early 20th century, cash value life insurance, it was much more common. Then it shifted towards the stock market being king. And he has a particular view on who benefited most from that shift.
He's pretty critical of the whole Wall Street system. His view is that the financial industry, they made a lot of money from that transition, especially when you look at 401ks, and other employer-sponsored plans, because they became the ones managing all that money. So on one hand, you see these huge, smart companies using this tool for stability and growth. But then you have the advice that most people get for their own retirement. And it looks so different.
It's a sharp critique. He's saying that, yeah, the stock market has grown a lot overall, but that hasn't necessarily translated into secure, predictable retirements for the average person.
Exactly. And he talks about something he calls the 401k predicament. It's all about how uncertain things are, about future tax rates, I mean.
Yeah.
When you retire. And that's something a lot of financial pros worry about, too.
He even talked to a bunch of CPAs, certified public accountants. And what they said is, it's pretty eye-opening. They're saying that a lot of people, when they retire, they end up paying more in taxes than they thought they would, which kind of takes away some of the supposed tax advantages of those deferred plans.
Right. The CPAs, they pointed out that once you're retired, you don't have as many deductions anymore. And when you take money out of your retirement accounts, you're paying taxes on all of it. So you might end up with less money than you planned for, less security.
So Thompson's saying that maybe that conventional wisdom, relying so much on the stock market, especially in those tax-deferred accounts, maybe it's not as universally good as safe as we've been told.
That's it. And this naturally brings him to something really fundamental to any financial plan. Understanding risk. Really understanding it.
He makes a really interesting distinction between what he calls smart risk and dumb risk. Can you break that down for us?
Sure. Smart risk, the way he describes it, it's risk that you calculate. You understand it. You know why you're taking it. You know what you might gain. But you're also aware of the potential downsides. It's about making informed choices.
Okay, so it's not about avoiding risk altogether. It's about being smart about it, really knowing what you're getting into. And dumb risk, that's the opposite then.
Right. Dumb risk, in his view, it's risk that you don't calculate. You don't fully understand the consequences. And he argues that for a lot of people, putting their money in the stock market without really knowing what they're investing in, that could be dumb risk.
And he ties this back to his argument for cash value life insurance, right? As a safer, more predictable way to save.
Yeah. He says that for many people, saving consistently in a tax-advantaged environment like a well-structured life insurance policy, it eliminates the need for risky investments. He even compares it to, how big corporations use it for their pension plans, that emphasis on safety and predictable growth.
Makes you think. It might be smarter for some people to focus on steady, safe growth, rather than chasing big returns in a market that can be so volatile.
Absolutely. He even contrasts Warren Buffett's approach, the famous investor. He says that's smart risk because Buffett really understands the businesses he invests in. But then he compares it to the average person who maybe doesn't have that level of expertise. And that could be dumb risk.
So we've covered a lot of ground. The history, the fact that big institutions are using this, the challenge to how we think about retirement, and how to understand risk. Now, let's get into the specifics. The advantages of cash value life insurance, the things Thompson highlights in the book.
Okay, so there's several key benefits. One of the first he talks about is the potential for growth. He points to a case study from Mass Mutual. They showed internal rates of return, historically, ranging from 5.65% to 6.22% over a pretty long period, from 1980 to 2013.
And then he compares that to, how the S&P 500 has performed more recently. He uses data from Crestmont Research, which shows much lower average returns, especially over shorter periods.
That comparison, it drives home his point. The growth within a cash value life insurance policy, yeah, it might not be as flashy as some stock market wins, but historically, it's been pretty consistent and competitive, especially when you consider that there's no market volatility to worry about.
Then there are the tax advantages,
Yep.
which seem to be a big part of his whole argument.
Huge part. He points out that any gains in value within a cash value life insurance policy, they grow tax deferred. That means you don't pay taxes on those gains every year. And if it's structured right, you can even take money out tax-free. That's because, well, dividends are treated as a return of premium, which isn't taxed. And your cost basis, just so we're clear, that's the total amount of money you put into the policy.
But there's a catch there with withdrawals, isn't there?
Right. He explains that if you withdraw more than your cost basis, more than you've put in, that extra amount, it could be taxable. But he also talks about strategies, like using a combination of withdrawals and loans to possibly avoid paying those taxes altogether.
And that death benefit, it comes with big tax advantages for the people who inherit it,
Yeah.
right?
The death benefit, it's generally income tax-free for your beneficiaries. And here's the important part. It usually bypasses probate. Probate, that's the legal process of, proving a will is valid and distributing the assets, which can be a hassle and cost a lot of money. He even uses Elvis Presley's estate as an example to show how estate taxes can really eat away at your wealth and how life insurance, that death benefit, can help protect against that.
That's a pretty powerful illustration of how much those estate taxes can take. And there's even a potential benefit related to Social Security, which I found really interesting.
Oh, yeah. Money you take out of a cash value life insurance policy, it generally doesn't count towards the income limit that can make you pay taxes on your Social Security benefits when you're retired. That can be a big plus compared to, taking money out of other retirement accounts.
So beyond the growth and the tax breaks, he also talks a lot about the guarantees that these policies can offer.
Definitely. He mentions that while the specific dividend amounts, those aren't always guaranteed. A certain portion of the growth, the overall growth in the policy, that is usually guaranteed by the insurance company. So there's a level of security there. And predictability. And he highlights the track record of, some of those top-rated mutual insurance companies, the ones he recommends. They've been paying dividends consistently for over a century, some of them.
And then there's the whole issue of, actually getting to the money in the policy. He explains the difference between taking withdrawals and taking out loans.
Yeah. And he's a big advocate for using loans against the policy. He explains that these loans, they're generally tax-free, even if you borrow more than your cost basis. And importantly, your cash value keeps growing, as if that borrowed money was still there. And your death benefit, that stays intact too. He even suggests that taking out a loan, it can actually encourage you to be more responsible, more accountable to pay it back.
He even gives an example of how the dividend rate the policy's earning, it can be higher than the interest you pay on the loan, so you can actually come out ahead.
Right. He uses a policy earning 7.1% in dividends, but the loan interest rate is only 5%. So you're making money while you borrow.
And when he talks about safety, he goes back to how life insurance companies performed during the Great Depression as proof that they're stable.
Yeah. He points out that back then, while banks and other institutions were failing left and right, life insurance companies, most of them, they stayed strong. They weathered the storm. He also touches on the difference between stock-owned and mutual companies. He prefers mutual companies because, well, they're owned by the policyholders, and they share the profits through those dividends.
Lastly, in terms of benefits, he talks about the flexibility, how flexible these policies can be, especially those high cash value policies.
He emphasizes that there aren't any, government limits on how much you can contribute or how little, so you can really tailor it to your situation. And he points out how flexible the premium payments can be. You can often structure a high cash value policy so that you can pay less later on, or even stop paying premiums altogether at some point.
So it sounds like if it's set up right, cash value life insurance can offer a lot. Potential for growth, big tax advantages, some guarantees, access to money through loans, a history of being safe, and a lot of flexibility. Right. That's quite a package.
You got it. That's a great summary of the key benefits he lays out. And from there, he goes on to discuss how this kind of policy can be a part of a smarter overall savings strategy.
This is where he brings in the idea of opportunity cost, the cost of missing out on something. And he applies it to those traditional savings accounts and other things that just don't earn much.
Exactly. He says if you're saving for something big, a purchase or an emergency, and you're just putting it in a low-interest savings account that's also taxable, you're missing out on years of growth that could be tax-deferred. And you might even be paying unnecessary taxes on any interest you do earn.
And his argument is that borrowing against a life insurance policy, it can actually make you better with your money, more disciplined.
Yeah. He says when you borrow against the policy, instead of withdrawing money or paying cash for big things, you're more likely to pay it back because you have that loan to repay. So your cash value, it keeps growing uninterrupted.
He even talks about how you can use this strategy to boost the returns you get on other investments by using those policy loans. Because sometimes you can even deduct the interest you pay on the loan from your taxes.
He gives a simple example. Shows how borrowing from your policy at a certain interest rate and then deducting that interest on your taxes, it can actually lead to a higher return after taxes on a separate investment compared to using money that's fully taxable. It's like getting a discount on your borrowing costs because the government lets you deduct that interest.
And he mentions specific benefits for business owners, too, if they use this kind of policy for their business.
Yeah. For them, he highlights things like using their business capital more efficiently, possibly paying less in taxes overall, and a more effective tax-advantaged way to provide life insurance for key employees.
To show how all this works in real life, Thompson includes some case studies in the book. Let's take a quick look at those, see how these principles might play out in different situations.
All right, so the first one, it's called consistent contributions. It shows what can happen if you regularly put money into a high cash value life insurance policy, like $20,000 every year. It shows how both your cash value and the death benefit grow over time. And it projects that in retirement, you could have a nice stream of tax-free income. In the example, it's $120,000 per year for 19 years. He also briefly mentions those banking concepts, like infinite banking. And he emphasizes that it's important to be responsible and pay back any loans you take against the policy.
The second case study, it's lump sum plus ongoing savings. This one looks at what happens when you start with a big chunk of money up front, $150,000 in this case, paid in 2 installments. And then you continue putting in $20,000 every year. This one shows how your cash value can build even faster, and you might end up with even more income in retirement, $160,000 per year in the example. He also talks about backdating a policy, which can speed up the growth in certain situations.
And then there's the third one, lump sum only. This one shows how flexible these policies can be. It looks at what happens if you just make a single lump sum payment, $150,000, split into 2 payments, and then you don't make any more contributions. It shows that even without putting in more money, the policy can keep growing and building value.
Those case studies, they really help you visualize how this can work in different scenarios, different ways of funding the policy, and the different outcomes you might see. Now, Thompson really stresses that word high in high cash value life insurance. What makes these policies different from, regular life insurance? Why do they perform differently?
The big difference is in how they're designed, how they're structured. He calls it folding. You see, traditional life insurance, it can take forever to build up a decent cash value. But these high cash value policies, they're built to do it quickly, efficiently, right from the start. The focus is on growing that cash value, not just providing a big death benefit up front. He even uses this analogy, like folding a paper airplane a certain way so it flies better. That's how he explains the difference in design. He also mentions that you can sometimes own a policy on someone else's life, which can be a strategic move depending on your goals.
Finally, he briefly talks about what happens if you close or surrender a life insurance policy. What do you need to know about that?
He mentions the surrender value. That's basically the cash value you get if you decide to end the policy. But he warns about the taxes. If you surrender a policy, any growth in the cash value beyond what you put in, that's likely taxable. So he really suggests thinking carefully before doing that. Yeah. Especially because of the tax-free death benefit for your beneficiaries. He also talks about alternatives, like converting it to a reduced paid-up policy. That way, you can stop paying premiums. But your cash value still grows, and you still have access to the money, and the death benefit remains, although it might be smaller.
So to sum it all up, it seems like Jake Thompson's book is making a strong case. Cash value life insurance, particularly these high cash value policies, they can be a really powerful tool for saving, building wealth over time, and planning for the future. And it's something that wealthy people, banks, big corporations, they've been using for a long time.
Exactly. He highlights all the advantages, the big tax benefits, the potential for safe, consistent growth, the flexibility of accessing money through loans, and even the possibility of boosting returns on other investments by borrowing strategically.
So for you listening, as you think about your own goals, your own financial situation, the information we've discussed today, it offers a different way of looking at things, a different way of thinking about saving for the long term, building wealth over time.
It raises a question. Maybe the real deep dive for you, now that you've heard all this, is to explore this further. See if this tool, this long-standing financial tool, especially in its high cash value form, could be a valuable piece of your own financial plan. Maybe even a missing piece, offering a mix of security, potential for growth, and significant tax advantages. That might even outperform what you're doing now.
Lots to think about.
Definitely.